If you clicked on this, you're probably curious about how someone can make money from a falling market. And I'm sure you've heard about how smart people used fancy tools and terminology like collateralized inverted hedge short put warrants. And by the way, that's not actually a thing, that's just something I made up, but I wanted to feel like I was intelligent for a second. So, there are a few ways that people can make money from a falling market, and now I'll outline them. The first one is a put option. To describe this, I'll first have to describe what an option actually is. An option is a contract where you have the right to buy or sell a share at a certain price. Now, as an example, if you have $1 million invested into a share, but now you've watched too many apocalypse videos on YouTube, and you're now worried that your multi-million-dollar portfolio could instantly be wiped away as our country turns into Venezuela. If you sell your portfolio and you're wrong, you lose. And if you don't sell and you're right, you'll also lose. But you can purchase sort of an insurance product that's called a put option, where for say $50,000, you have a guaranteed right to sell your current $1 million portfolio at its current value from today up until the next year. And for the party selling the right for $50,000 to sell at that $1 million value, they are assuming that the market is going to continue to go up and that they'll just be making an easy $50,000 for nothing. But now, let's just imagine that you do not actually have a $1 million portfolio, but you decide to purchase this $50,000 put option for a year. This is called a naked option, meaning that there's nothing to back it up. Now, if the market rises, you lose $50,000 and all of it. But let's just say that the market did actually fall by 50%. You could then sell that option for $1 million, making you an easy $1 million. You can do the same thing if you want to guarantee to buy at a certain price, not just sell, and that is called a call option. But before you think that you found an easy way to make money, bear in mind that the sellers of these put options and call options have done a lot of research and a lot more than us. And they have factored in the upfront costs of these products and factored in the risk calculations. So in reality, there is no good way for a normal person to invest in these derivative products. In point of fact, the majority of the people that actually purchase these products are actually using them as an insurance or protection of the major portfolio rather than for speculation. This product is designed to be a safety guard or a safety rail rather than a get-rich-quick tool. So that's the first strategy, a put option. Now the second way that you can make money from a falling market is to do what is commonly referred to as short selling. Now this is very different from the above strategy. Imagine that I want to buy and sell a car for a profit. Now in a normal world, I can only sell the car after I've already purchased it. But it does not work like this in the share market. In the weird and wacky world of share trading, I can sell the car before I even buy it. Let's just say that I sold the Tesla Model S for $91,000 without actually owning the car. What would happen here is that the broker will provide the buyer with the car so they can drive away with it. But now I owe the broker a Tesla Model S and the broker owes me $91,000. But this transaction can be delayed indefinitely. If the price of the Model S were to fall to $50,000, I can then buy a Model S for $50,000 and then take the $91,000 that's owed to me after I give that $50,000 Tesla Model S to the broker. If the price of the Model S goes up to $100,000, however, I'll lose $9,000. Now, as far as the time frame for how long a short sell can be, it comes down to the broker. The broker may see that the price has gone up to $110,000 and they see that I only have $19,000 worth of cash in my account. So they start to get a little bit nervous and then they may force me to buy the Model S now and then do the exchange. And another situation that limits how long you could have a short sale going for is the fact that you might be paying interest on the debt. For if enough time passes, the bill on the interest will erode away any potential gains that I would have made from doing this Tesla Model S going down. So that is short selling. And now, for the third and least reliable method to make money from a falling market is to invest in inversely correlated assets. I know that sounds very technical, but let me explain. Now this is more ethical and clean than the other two methods, as you're not hoping for someone else's suffering in order to become rich. You are hoping to become rich through your assets going up, which sometimes, but not all the time, is triggered by another investment going down. For example, if someone believed that the share market was due for a crash, they could invest in government bonds. After the share market crash, the government bonds will likely have lower interest rates, which to stimulate the economy, and then that'll make the old government bonds increase in value. But this does not always work. For example, during many market crashes, many investors have bought into precious metals because theoretically that is meant to be inversely correlated to the market conditions. But unfortunately in the modern world, this has not always been the case. So, thanks for watching, and I now give you permission to watch another YouTube video. Not that you need my permission anyway, but I'm giving it to you anyway.